Contrasting Viewpoints with Ray Sclafani and Mark Hurley.
Ray has been one of the leading consultants in the financial services industry for many years, and Mark has annoyed countless people throughout the wealth management industry over the last 25 years with the white papers he has written. Today, they're going to provide their insights into what is really going on in the industry, some of the more absurd things they've seen, and also for anyone in this industry, some issues they should be thinking about as they try to build their business.
Well, welcome back to our final episode of 2024. My name is Ray Sclafani, and I'll be your co-host with my good friend Mark Hurley. Mark, it's great to be back with you today.
Great to be back with you too, Ray.
Okay, so we're talking about Abu Dhabi once again. It's in the headlines. Different business models of the future, a variety of succession options, and I'm curious what it takes to make the list, 52 of the best RIAs to work for. Our favorite segment of our episodes, You've Got to Be Kidding Me. Today, we're going to take a break from Brooke and target Kenneth Corbin at Barron's with the headline, What Will M&A Look Like Under the Trump Administration? But our main topic, what is really going on with M&A in the jungle? Mark, what do you say we get started?
Let's go.
Okay, so Mubadala Capital, an asset management subsidiary of Abu Dhabi Sovereign Wealth Fund, the Mubadala Investment Company, has agreed to take the Canadian asset manager and RIA financer, CI Financial, private in an all-cash offer that values the company at roughly $8.66 billion US dollars. Now, CI's U.S. wealth management subsidiary, here's where it gets interesting, Corient Private Wealth, is currently minority-backed by Bain, the Abu Dhabi Investment Authority, the state of Wisconsin, Ares Management, and FlexPoint Ford. Corient has roughly $185 billion in client assets. Mark, what's your take on this story?
Well, first off, the minority stake was given because the company got basically outkicked its punt coverage. They were one of the most aggressive buyers of wealth managers. They were extraordinary leverage. Then when Federal Reserve started raising rates, they found themselves in a really difficult position. So they had to issue a billion-plus dollar, 14.5% Pac-Man bond, which is, it's a payment in kind bond. I mean, you haven't seen these things since the roaring 80s. Like, people are using these things because rather than getting cash, you get paid more equity. So the company's stock was down substantially from its peak, and Mubadala showed up and just agreed to buy the entire company and take it private. What's it going to mean for the industry, and why should everybody care? Well, first off, it's going to create the opportunity for Corient to be a much, much more formidable competitor. Keep in mind that sovereign funds are worried about, what the investors are going to do worth 20, 25 years from now.
They're long life capital partner investors, right?
Yeah, they're intergenerational investors. And most of the PE firms coming in are flipping this between funds that are 5 to 7 years in length, which is kind of crazy when you think about what this business is like. Now what you're going to have is management is going to be told, worry about building as much enterprise value as you can. Abu Dhabi has oil that's about 10 or 11 feet below the surface. So they can basically break even at $10 a barrel. So they have no problem in terms of getting cash. They got cash coming out the wazoo. What they're looking for is a place to put money to work and build value over many years. So this will give Corient a very important advantage, because fundamentally the opportunity in this industry for the next 10 to 15 years is organic growth. The industry is going to go more than double in size in terms of the number of clients. But organic growth is not something you just turn on a dime and do. It takes a long while to get going. The second reason why this is a really big deal if you're in this industry is that it presages what's going to happen in terms of who provides the capital to all the aggregators in the industry. Now, we've all seen these prices that have gone bananas because the PE firms have capital that they can't put to work. About $1 trillion of dry powder, according to the United States Senate. But if you actually dig down through that, they have to give in co-investment rights to their investors that don't show up in these numbers. They really have about $2 to $2.5 trillion they got to put to work. And the people who give them the money are the sovereigns. And undoubtedly, some are starting to wonder, okay, why am I giving money and paying lots of management fees for a 5 to 7 year investment when in reality I could do it myself, and I really want to hold this thing for 20 or 25 years. And so what I think you'll see over time is that the PE firms that now dominate the aggregator landscape are gradually going to be pushed out by the sovereigns. Now, when you say sovereigns, you don't just mean entities such as Mubadala, which is part of the Abu Dhabi Investment Authority, or Qatar, or even the Norwegians or the Singaporeans. For example, you have the Canadians, and they have people who are as sophisticated as KKR or CDR and these other places doing direct investments already. So it wouldn't surprise me to see a Canadian firm come in and do something like this. But on top of that, you're going to see wealthy families. I mean, tell me what's the difference between a guy who's
Big
got
family offices are getting involved as we
you
speak.
got $100
right?
billion. Wouldn't this be a great asset to own for a very long time? Much better than the alternatives. And you're not paying very robust management fees with everything else. Now, to be sure, who becomes the backer could be potentially problematic. Mubadala, for example, is part
Well, that's
of the
my
UAE.
question. It's the UAE. It's a UAE company.
Yeah, and the UAE has been heavily criticized by Human Rights Watch, by Amnesty International, and even the U.S. State Department for some of the issues there. And as you understand, there's a large segment of our country that could be very important. At some point, I would be surprised if their competitors don't point this out. Although, if you actually see the ownership of Korea, a majority is actually owned by the people who work there as opposed to the outside investor. Because they're getting stock in the company as part of their deals that they did. Third reason why this is going to be really big is that if you're a PE firm, the people who used to give you all your money to invest, well, they're now doing it on their own. And where do you think they're going to go to get money? It's already starting to happen. Wealth management industry. This is the $57 trillion of addressable assets. It is just waiting in terms of your PE firm to come in. Where you're going to get your money if you're going to stay in business long term is going to be from firms that we talk to here every month. Now, that said, as anyone who's ever marketed to this industry, it should be entertaining to watch because most of these guys are like people going into Mongolia and not speaking Mongolian. It's a very long
PE
sales
firm's
cycle
very
here.
different, but there's something else that is really getting my attention on the sovereigns, and that is we are at the beginning stages of the largest wealth transfer that this country's ever seen. So smart money, long-term capital is showing up at the early second inning of what will be between now and 2045, by Cerulli's estimates, billions and billions of dollars of wealth transfer.
Yeah, I mean, there's two schools of thoughts on that. There, also Chip Rome has made similar forecasts. The other side of this, though, if you look on the longevity side, all those assumptions they've made have been based on certain longevity models. And if you look at what the Stanford Longevity Center has found, most of the increases in the stated rates of longevity are tied to declines in infant mortality. But all the stuff from better medicines, better lifestyles, et cetera, is not yet reflected in the number. So the other side of that equation may be that people may actually live longer. But quite candidly, I actually think it's not that important, just because if you look at the number of people between the ages of 45 and 60 in the United States, there are 7 million more in that range than there are 60 to 75. This means that the number of potential clients in this industry is going to more than double. If you do get the wealth transfer, then this is like this times 5 in terms of what the opportunity is.
Yeah, so it
Regardless,
sounds like
it's phenomenal.
It is phenomenal. We may disagree how we get there, but maybe that's a topic for a future episode. I think that's something worth digging into because however you get there, the smart advisors are gearing up for more organic growth. They're investing more in marketing. They're building their brands because they understand what's to come. And I think sovereign money, smart money, long-term capital money coming into the marketplace is indicating for me, for at least the advisors we coach, this is a pretty smart move. Pay attention. There's a reason to
greatest
invest.
industry in the world to invest in right now.
All right, so let's go to Evan Simonoff's article this month, Business Models of the Future. You know, it's funny, a decade ago, anybody who thought a fast-growing Kansas advisory firm like Creative Planning would sport a $16 billion valuation. Most definitions of public mid-cap companies fall under 10, so that really gets everybody's attention. They would have been laughed out of the room. So trying to anticipate what firms are going to look like in 2035, you got to have a powerful telescope, says Evan Simonoff. So Cerulli projects, and here's our wealth transfer number that you obviously disagree with. Between now and 2048, 124 trillion in wealth will be transferred in the U.S. Of this, 105 trillion is expected to flow to heirs, 18 trillion donated to charities. There's a lot of money in motion, and the value of these firms, these business models of the future, may look very different than they do today. I have a thought about this. I'm curious what your take is.
No, I'm in violent agreement with you that everyone's going to have to evolve their business model. And as we talked about in that paper we did about a year ago, we think the kind of three groups of firms will emerge.
This is the welcome to the jungle for those that aren't familiar.
Which we name our podcast after. I mean, you're going to have some extraordinarily large firms. You're already seeing them starting to emerge, but they've not really fully evolved. Firms that are become these mega firms are going to be direct competitors of people like Schwab and Fidelity. They're going to offer more services. They're going to have to. They're just be fully integrated businesses.
Yeah.
And the owners of them will do extraordinarily well. That interesting statistic you were saying about the 16 billion. You know that in the United States in the last 20 years, there's been only 250 companies with a market cap in excess of 10 billion. Now there's 251. Shows you how amazing successful that company is. But in terms of business models, the really interesting one, in my view, and Evan touches on this, is going to be people who build sort of specialty practices. They're going to figure out how to target certain segments of the industry of potential clients. And they're going to do that by becoming very, very good at a specific set of problems and helping address that. And part of that, at least I argue, is they're going to help clients not just manage their money, they're going to help them build their capital. And the ones that pull that off and can brand themselves well are going to have fabulous businesses. They aren't going to have to be that large to be insanely profitable and incredibly valuable.
Okay,
the last group,
the
last group's going to be everybody else, which is, they'll make a fine living, but their business
is lifestyle practices, small practices. So let me touch the third rail on this. And for those that are not from New York, the third rail is the electrified rail on a subway line. I always say that, and people go like, "What is he talking about? The third rail? This is the rail you don't touch. It will kill you." And I'm going to touch on the third rail here. I'm curious to get your take. This AUM pricing has been, as Mark Tibergien has said, an opaque way of pricing services on a variable basis that didn't tend to ring any alarm bells for their clients, especially when expressed in basis points instead of dollars. Now, I respect Mark a great deal. I agree with him. And he and I both do some work in Australia. The regulators there, they changed this. They now require advisors to quote the fee in dollars in advance of their first year of service. And so I'm curious, what do you think will happen here in this market? Will we see a shift from basis points on assets to dollars and overly stated dollars for service? This is one of those where advisors shake in their boots thinking they've got to call Mr. or Mrs. Lubner for a $2,500 check every 90 days to manage their portfolio.
That's funny. I wrote an article about 6 months ago addressing this thing. It was involved the subscription model. And my argument is that when I agree with everything you said and Mark, because I never disagree with Mark Tibergien. I do disagree with you a little bit on the side. But what I think is going to happen is and the fee model is not going to change. The service model is going to change.
Yeah.
This is an industry where historically, no one's really noticed the fees because the market's gone so much. And this year we had another roaring bull market in the S&P. But at some point, if it normalizes, big guys will start acting like big guys in other industries. And currently, if you go to a firm that has 10 billion, you go to a firm with 1 billion, they both will say, we do A, B, C, D for X dollars. At some point, the big guys are going to say, we're going to do A, B, C, D, E, F, G, and H.
Well, you're seeing it today,
much harder
right?
on the smaller guys.
Peter Maluk's doing it at Creative. You're saying
He's
Merit
doing it right
Financial
now.
doing it.
Marty is starting to expand his service offering also. And what that will do is maybe the compensation model won't change, but the value model is going to go up significantly higher. The advisors are going to have to do much more for the same dollars. And to do that, they're going to have to be much more efficient or far more specialized, because that gives you, when you really need a specific expertise, you're willing to effectively pay a slightly higher price for that. And also that firm doesn't have to spend a lot of money on marketing because clients find them. And that's how these firms will sustain their margins.
So it's a value equation, effectively, is what you're saying. And that is advisors just need to continue to hone the value they're advising and creating in partnership with clients, but also get good at articulating it as well.
Yeah, but most of them, quite candidly, are really sort of asleep at the wheel right now about this because you had another roaring bull market this year. I mean, turning on the lights, your EBITDA went up 15, 20%.
Okay. Yeah. So
as soon as that ends, it's going to move quickly.
Yeah. Good. Okay. Good. Let's go on to the next story. Scott Hansen from Investment News provides this variety of succession options. It's a really good article, interesting article. He says here, no one gets out of here alive, which I thought was interesting. The fact is, whether you have any interest in planning your business succession or not, your business will lose you. You will either be struck with an illness or disease that will take you out, or you will die. And he's pretty direct about it, but he offers some alternatives. And I thought it was a good wake-up article for folks to read, especially those advisors in their 50s and thinking about the optionality. Here we are at the end of the year. People are looking to the future. They're making plans, sharpening their pencils, and thinking, what does the next 3 to 5 years look like for my company, my business, my career? So I'm curious what you thought about this particular article.
Well, in 2015, I and several of my partners in the last company co-authored a paper that looked at the psychology of buying or selling a wealth manager. And if anybody wants to contact me either through Ray or directly, I'm happy to get you a copy of it. But the key thing to understand, there's a fundamental difference between legal ownership of a company and the economic ownership of the company. Like it or not, you have to actually be there working to sustain these things. And the relationships are everything. That's what the entire business is about. And at some point, there's this shift that occurs in power regardless of the legal ownership. If the owners get too old so that they couldn't sell the business and rebuild it, should the successors quit at the time you're trying to sell it, no one will pay any money for it. Reality is there's this sort of tipping point. It typically occurs in the early 60s to mid 60s, where the owner will take it to market. The successors, if they try to hold it hostage, he literally can replace them and then be able to come back to the market before he's too old. But once you get past that point, effectively, it's up to the successors to decide what the value it is. Now, the other thing that we talk a lot about is that many people say, well, look, I just want to sell it to my successors. I really don't care about the fair value. And that's very noble, and that's important for a lot of firms to do. The only qualifier I would give that to you is I can assure you with metaphysical certainty, your successors will get full and fair value for the business when they sell it, because this happens again and again in every other industry. And so there's a lot of decisions you have to make when you do this. But this article, I think, really went to the point that this is not something you wait until you're ready to go. You got to start thinking about this now.
This is a minimum of a 5 to 7 year planning process.
Yeah, and I would encourage 10 years at least.
Okay, so let's go on to the next topic, which is the 52 best RIAs to work for. I thought it was pretty clever of financial planning. It's unlike maybe some of the other ads and awards that we've seen before. I do take issue, though. The author, Nathan Place over at Financial Planning, says in recent years, there's been a mass movement of financial advisors away from wirehouses and other brokerage models towards RIAs. I don't think it's been a mass movement. In fact, the breakaway broker story, man, if I have another nickel for all the times I've heard breakaway broker, it hasn't been mass numbers. It's been larger advisors leaving. And the data points to that over the last 6 years that we've seen the number of RIA-only professionals jumping 51%, but the bigger wirehouse advisors with bigger books of business recognizing the difference between exit value and enterprise value. And so this article was really interesting. It did point out for me that there's a really good reason to think about creating an environment that is the best place for people to work, and why the RIA model is unique and different. So a good little tilt, I thought, in thinking about it this way.
No, I think it's very forward-looking. A couple thoughts, though. One, as you mentioned, publications love to create awards because then they can host banquets, and people pay lots of money to get tables at these things. And it's a great source of revenue. It's even better than conferences now, because it's very hard to get a lot of people to show up for a conference, but they will show up for an award ceremony.
Did they do an award ceremony for this one?
What?
I didn't get invited to an award ceremony for this one.
Well, I haven't gotten any awards, but I've been to a few of these events, and like there's one where it's like they have an auctioneer going. There's so many awards being given out. But again, they serve a purpose. They help firms with their businesses in terms of branding and stuff. What's interesting about this is that the financial planning recognizes there is about to be a shift in a lot of employees who were successors who didn't get bought out, but really didn't get that big a piece of pie as part of the transaction. And many of those are going to be looking for a place to go. And so they started an award which says, what are the best places to work? Now, if I was going to be critical of this, it would be the fact that you have to survey your own employees. And so it's amazing how certain firms manage to get all their employees to sing the company song and say how wonderful everything is. So we're a fabulous place to work. But it's an attempt to say, look, if you want to recruit somebody, you got to pay market value. Let's agree on that. But after that, there's a bunch of intangibles that are very important. And it's part of this whole branding strategy that people are doing.
Okay, so our favorite part of our episodes, you've got to be kidding me. What will advisor M&A activity look like under the Trump administration? So we're skipping Brooke this month. Let's target Barron's here. This is an interesting article. The incoming Trump administration is expected to create a climate that will drive more M&A in the RIA space, say industry insiders. Everyone's waiting for the number of RIA acquisitions per year to reach a tipping point that increases the number of transactions from, they say, around 250 a year to several hundred, says Dave Welling, CEO of Mercer. What's your take?
Well, one, Dave's a very smart guy. But let's be clear, the tipping point is not a new administration. The tipping point is demographics. And the article, which Dave is just they're taking Dave out of context. The article is saying, oh my goodness, this new administration, M&A is just going to be fabulous. I don't know how it could get more fabulous. The only way you get more deals currently in the industry is if you took hostages. The typical wealth manager it's sold for one reason only: demographics. These businesses spray off cash flow. They're growing fast. It's only at a point where the owner has to sell or they really won't get anything for it. And effectively have to give it away to their successors. If they don't do it, do you see deals happen? Demographics drive deals here. Yes, they had the chairman of the FTC being replaced, and so there'll be more M&A in general. Absolutely. But that's not had a scintilla of an effect here. And I know of a firm that was just sold. The deal's not been announced yet. They had 32 bids. 32 bids.
Oh, yeah.
It's like a conga line of bidders. So there's no shortage of money. There's no shortage of buyers. The only shortage is sellers.
Well, that leads us to our main topic, right, for today, which is what is really going on with M&A in the jungle. So I find it really interesting, the number of transactions reported, whether it's a Dave DeVoe report or an Echelon report. We're seeing even AGS, John Furey's company, producing some reports around transactions. I still think the number of transactions reported seems relatively low. In fact, I had a banker here in my office a week ago wanting us to recommend them on a number of transactions that we're advising advisors on. And we don't take success fees at ClientWise, so we're conflict free. But what I found fascinating is all the individual transactions at a local level that don't get reported because they don't have a banker. And so there's something really happening at a local level that's unique and different. And many advisors are reporting to me that they don't want to go through a PE transaction only to have to recapitalize another 5 to 7 years later. That as they approach their late 50s, they're thinking, wait, who's my long life capital partner? I want to do this recapitalization like one time and find somebody who wants to play the long game. So there seems to be, for me, my observation is a shift that's going on in the marketplace.
Well, there are many transactions. You're right. Because there isn't some federal obligation to file directly. Way most people track these things is because there's a change in the Form ADV. They when you do a deal, a different owner shows up, or they fold it into another company. And granted, bankers put out press releases because they want to tout how amazing they are at doing banking. Buyers who are aggregators want to tout how amazing they are at doing acquisitions. So certainly there are many that are falling through the cracks. But the big thing to keep in mind is that most deals are relatively small. Now, when I say small, I don't mean 10 or 20 million. I mean less than $500 million. Fidelity does a very good job of tracking at least the major transactions in their report. And they totaled about 134 through the end of Q3. And that excludes all these deals that Focus is doing with itself. I don't really count
the internal transactions. Yeah, carve those out for a second because that's
right. I mean, it's fun. It sounds great for numbers, but there are only 4 over $5 billion. And some of those included multifamily offices where the average client size is ginormous. So that's even assets are not a good indicator of what's really going on transaction wise. keep in mind, if you went from, say, 130 to 1,300 tomorrow, there'd be plenty of buyers for them.
I had a banker tell me 2 weeks ago that there's more than 10 buyers for every seller.
Yeah, for anything that's material, it's over 30. In fact, a banker I ran to at a conference recently criticized another banker because he says he brings too many people in to bid. I'm like, wait, he's representing the seller. Give me a break. He's trying to get the best value for the seller. The way to think of this is that if you swing a dead cat right now, you'll hit someone wanting to be an investment banker in this industry.
That just sounds terrible.
I mean, it's like everywhere you look, everybody's. I think my mother, who's 95, would like to be a banker because they've seen so many transactions go by, and they just, many opportunities to do stuff. There's some extraordinarily good bankers out there. They're handling most of the large transactions. A lot of the smaller transactions have been handled through FP Transitions, which has done an extraordinary job. But the whole thing that's driving this is not, what you're thinking. Oh, if the price instead of was 15 times cash flow, it was 17 times cash flow. Oh my goodness, there'd be lots of buyers. This is not a price elasticity. This is entirely driven by demographics. Now, 5 years ago, this was fun time to be doing this. For starters, you had lots and lots of money you could borrow for next to nothing. And then on top of that, there were a lot of big firms and some extraordinary organizations where the founders were hitting that mid-60s range. And they recognized they needed to do a deal. And that's where you saw multiples as high as 30 times cash flow on transactions. I know firsthand of some of those that actually occurred. More typically now you're seeing on a trailing 12 basis, closer to 20 times. I talked to a PE firm the other day and they said they've not seen anything below 20, but they're not seeing 30 anywhere. What they'll typically do is they get into a room and they try to figure out what they want EBITDA to be. And with the PE guys, my guess is, can we keep a straight face when we use this number? Because some of the numbers they come up with are insane. They call it's projecting all these wonderful things to happen for so many years, and therefore your run rate EBITDA is this. That's why the prices are so high. But again, the problem is that most of the mid-size of this market, when I say mid-size, I would say, 3 billion to 20 billion has been acquired. It's already been bought out. There's still some left, but most of them have already been acquired. So the preponderance of transactions tend to be
bulk of the
less than
options
$1
going
billion.
to be lower in size.
Yeah,
and there's still
transactions in 9 months that are less than $1 billion.
So there's at least $1 trillion estimated in PE money and dry powder on the sidelines. And my understanding is that doesn't even count some of the sovereign debt that we're starting to come into the marketplace.
Yeah, and actually that $1 trillion, as I mentioned earlier, is a little bit understated. And what I mean that is, if you're running a PE firm, the way your investors squeeze you is they'll say, fine, I will give you $500 million to invest, but you have to give me $1 billion of co-investment rights on deals with no fees. They effectively cut their fees by 2/3 by doing that. So, but in order to get the management fees on the 500, they got to deliver on the co-investment, meaning when you say $1 trillion of dry powder, it's really $2 to $2.5 trillion that these guys have to find a place to put to work. And oh my God, this is hard to do. Wealth management is great because you're remotely likely to lose it unless you over leverage. It's a fast growing market, stable cash flows, et cetera. But there's no shortage of money. There's oceans of money. If you have an attractive wealth management firm, I believe you could stand on the roof of your building with a bullhorn and announce that, and you'd be surrounded by bidders in about 20 minutes.
Yeah, but the question is, how do you go about announcing it without putting a for sale sign on the front doorstep? And
well, that's the challenge.
Right.
And what you have to do is, I strongly recommend if you have a reasonable size firm, you should get a banker. And there's some very, very good ones out there.
And so what's a reasonable size firm in your mind?
It's not tied to assets. It's entirely tied to your EBITDA. And if you're generating, $4 or $5 million of EBITDA, you should have a banker, even maybe 3. Okay.
Well, it's interesting because you mentioned FP Transitions. David Grouse Sr. has now retired from FP Transitions, and they generally don't work with firms with that high an EBITDA.
Yeah, and they're very good at helping firms that are
much smaller in size. I would
smaller,
think.
And they know the right parties to match them to, and they've done they're doing, I think, 8 deals a month. I think right now, these smaller ones that you'll never see show up anywhere on these numbers.
Yeah, that's right. That was my point earlier. I'm seeing more and more of those transactions. What's interesting, the reason I bring that up is some of the larger aggregators are getting smart, and they're building these hub and spoke models where they're going deeper in these smaller markets and really tapping into the firms that might have 80 to 250 million in assets, and there might be two or three of those in a local market that they can roll up together into a sizable $700 million part of their firm and build a regional structure. So I'm noticing the PE is taking on maybe some different flavors in terms of how they're thinking about scaling and expanding and growing through M&A.
Absolutely. And a point you're making is that there's no financial arbitrage anymore.
Wait, I don't know that I agree with that.
Well, what I mean by this is that the pricing is so robust and so efficient that where you make your money is what happens after the deal's over.
Yeah, I'm with you on that point. And nobody wants to do a deal if there isn't some kind of synergy and an opportunity for growth post-transaction.
But you have to execute to do that.
Yeah, you got to execute. But go back to the arbitrage comment, because I just don't think that's true. I mean, if somebody's trading at 24, 26 times EBITDA, they're not buying something at 24 times EBITDA. There's an arbitrage.
What entities that are public anymore? They've all kind of gone private. And the reason being is the private markets play much higher multiples. And the buyers are private buyers right now. And they're paying 20 times cash flow for these types of firms. So as a consequence, I mean, and what I'm comparing to is really 5, 6, 7 years ago. Back then, there was literally an arbitrage where you buy something at 20 times, you leverage it out the wazoo, and as long as the market keeps going up, you're printing money. Sure. And quite candidly, that's how we have several of these very large aggregators that aren't really businesses. They're like confederations of small businesses that have never been integrated.
Well, that's what United Capital was all about before they sold to Goldman. It was, land of the small
to Joe's credit,
solo
he sold for a full price.
He packaged it up. Yeah, but go back though to this arbitrage thing. I don't want to mislead a listener who's listening to this. Here's Reality Ranch for me. I'm looking at firms, and we coach and work with, and I'm on boards of firms that are large aggregators. Yeah, they might be trading at 24, 25, 26 times EBITDA, but they're buying firms at 8 and 10 and 12 times. I think I've seen a couple of 14s, but they're not buying 20 times.
Well, again, it depends on the size of the firm. But for a firm that has any materiality, the number's 20 right now, according to the various buyers I've talked to.
Okay,
and the question is how big it is. And understand, too, that the question is EBITDA is like balls and strikes. It's depending what you believe the EBITDA is.
Yeah, what your add backs are. And
you got it.
I
can get you to any number you want to if you let me define that. The thing that's also interesting, it's occurring in the MFO space when you're seeing M&A occurring, is that you're seeing a real tendency towards developing more fully integrated businesses. Now, if you're working with really wealthy families, a guy who you have $50 million from isn't going to pay you, it's not going to pay you a lot more than someone, a guy pays you has $100 million, they're going to pay a lot more than $50 million one. Yeah, there's a cap on what they're going to pay you.
Just to be clear,
they have all these assets.
MFO, for those listening and may not know, it's multifamily office.
That's right. Right. And so if you look, there were like 3 deals that were done recently in the MFO space, which show up in the numbers that I'm talking about. And it's clear what they're doing is they're buying firms that have lots of pooled vehicles, because now they have other things they can offer the client if the client wants to put money into. And if they do, they get fees off that money. Because again, they're not getting paid on $100 million. They're getting paid the equivalent fee of, say, on 30 or 40 million. But if they can get the person to invest in the pooled vehicle, they capture additional revenues that way. And this is a trend you'll see increasing with MFOs. We saw this last time we went through this cycle. And this is why I believe the same thing will happen ultimately with these mega firms, that they're going to have to do so much for the clients, and the market quickly will move towards efficiency, that the way they'll be able to sustain their margins and grow their earnings will be adding additional services. Peter's already doing this. Peter Maluk at Creative, for example, he's looking into providing technology platform services to small business clients for their businesses as part of his business.
Okay, so I had an unplanned part of our segment as we begin to wrap up here. I'm going to put you on the spot. As a futurist who's often wrong but never in doubt, what would you say are your top 2 or 3 predictions for the wealth space when it comes to M&A in 2025?
I think it will be, one, I predicate everything on the market. If we continue to have a roaring bull market, the only deals you will see in any way, shape, or form are people getting old, the sellers, period. I think in terms of M&A, beyond that, I think you will see several more sovereigns come in and replace the PE backers. I believe that's you saw Fisher. There was an
the
investment
Abu
made
Dhabi
there, but it wasn't
investment
a
fund.
controlling investor. Here you have a controlling investor.
Yep.
And I can assure you, every sovereign around the world woke up and went, "Whoa, how did we miss that?" Because Corient is a fabulous firm.
Great firm.
Oh,
for
great
sure.
firms they bought.
Yep.
So I think that's the one thing you'll see. If we have a rough market, you could see people that say are in the early 60s as opposed to mid 60s may decide, okay, my EBITDA is not going up 20% a
so
year
let
for
me
turning
hang
the
on.
lights on.
Mhm.
Perhaps it's time to do something. And if we have a robust bear market, you may see some more stuff come out of that. But I think that's the determining factor. As long as we get a 20% a year on the S&P, boy, it's like sitting in front of a fire hose throwing $100 bills at you. I mean, why would you sell that?
All right, Mark, what a great conversation today. We covered a great amount of topics. And thanks for taking a swing at somebody other than Brooke today. That was really great. It's been fun working with you this year and look forward to a 2025 together.
It's been fabulous, Ray. I really enjoyed it. Thank you.